Welcome to the Money and Wealth Show, brought to you this week by AmericanManganeseInc.com. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, the program that offers you opinions every week on the economy, business, and the markets. And this week is certainly no exception. It's a pleasure to welcome Eric Coffin to the program. Mr. Coffin is a newsletter writer. He and his brother David are the Hard Rock Analysts. Hi, Eric. Welcome back.
Thanks, Sterling. Thanks for having me again.
Haven't seen you for about a year, and my, what a tumultuous year it's been.
Yeah, it's been interesting as the old Chinese curse goes, and unfortunately it's probably going to stay interesting for a while by the feel of things.
Well, I'm just trying to think of, we saw each other literally about a year ago.
Yeah.
What was the price of gold about a year ago right now? Was it around $850, $900, something like that?
Yeah, I think it was basically trying to get to two and through four figures, and now it's obviously accomplished that. It's sitting over 1,500, so it's had a pretty good move.
Why has gold moved so much in the year since we last talked?
I think a lot of it is the inverse relationship, the normally inverse relationship, I should say, between the U.S. dollar and gold. There's not a lot of pretense coming out of Washington. They don't want the dollar to be high. They've kept their interest rates artificially low because you've seen developing countries that are actually more worried about inflation start cranking their rates up and start cranking up their reserve requirements, their banking system. These other currencies are strengthening. The U.S. dollar has been dropping until the last week or so. It was basically dropping like a rock. And that sends the gold price up because gold, in most people's heads, the way most people see it quoted, is in U.S. dollars. And so there is an inverse relationship.
Eric, the Secretary of the Treasury of the United States, Mr. Geithner, keeps parading around the world, talking about that strong U.S. dollar. You and every other analyst in the world have just said the U.S. are in the process of deliberately devaluing their dollar. So who on earth do they think they're kidding?
Apparently, the voters in the U.S. I mean, I'm not even sure why Americans would care. I mean, it's a funny thing in the U.S. There's a political aspect to it. Americans have this sort of fantasy of the strong greenback. I mean, you have to play to that in Washington, even though everyone on both sides of the House, certainly everyone in the Treasury, everyone in the White House knows it's a crock. I mean, there's not a lot of pretense. If you're the world's biggest debtor, which they are, if you can get the world to lend you money at 3% on a 10-year note, which they can, and if the world is willing to keep lending you money on those terms and let you pay them in devalued currency, frankly, you'd be an idiot not to devalue your currency. Like, why would you not do that? It's the totally rational thing to do. But politically, you're not allowed to say that. It's bad. You have to go, we're for a strong dollar. Even while you've got the Treasury buying up T-bills and pushing rates down below 1%, you're still going to do the rah-rah.
So the reason basically, though, for the big move in gold in the last 12 months is the devaluation of the U.S. dollar. What other factors are at play? It can't all be about the greenback.
It isn't just about the dollar. There's a couple of other things that have helped. I mean, the other thing that's helped, of course, is just the fact that there's so much uncertainty with problems, U.S. debt, Euro debt. Basic uncertainty is you've seen a broadening of gold in terms of purchasers for two reasons. One, as an alternative currency, viewed that way, and another, there's definitely more insurance buying in the gold market. I mean, people are simply picking some up, putting it in a sock and forgetting about it, and that takes gold out of the market. And the one group that's hasn't really been lauded for buying gold until quite recently, because most of them only report once a year, is central banks. A lot of central banks have actually switched from being sellers to buyers of gold. There's been actually quite significant purchases of gold by a number of central banks in the last year. They've probably picked up 300 or 400 tons collectively, which is a lot. I mean, the physical gold market's not that big.
Exactly. Now, here in Canada, we mine a fair bit of gold. Not all the world's gold, certainly, but certainly more than our share, percentage-wise. And yet our central bank is one of the smallest holders of gold bullion on the planet. How do you connect those dots?
I think there was a period there in the 90s where a lot of central banks, and after the run in gold up to $800 in 1980, there was this whole move completely in the other direction, the whole barbarous relic, we got to get rid of this stuff. Canada went along with it. We had a fair amount of it because we are such a big gold mining country.
Exactly.
A lot of gold still does get sold to the Bank of Canada, and they in turn turn it into coins, but are quite popular. Canadian gold coins are very popular.
Sure.
But in terms of holding it as a reserve asset, the Bank of Canada doesn't seem to really have any interest. I mean, it's been brought up to them by a number of people a number of times, and they don't seem to have any inclination to buy any of this stuff. I suppose they figure if they want to start picking it up, we produce enough of this stuff that they know where to get their hands on
There's
it.
plenty of it in the backyard, so
Yeah.
to speak. And yet China has gone out of its way, one of the few governments you've just mentioned,
Yeah.
whose central banks have been aggressively buying enormous quantities of gold. So what's their reason? Ours seems to be the opposite of where they're going.
Oh, theirs is definitely trying to broaden their reserve assets. Right now, their biggest reserve asset is U.S. dollars, mainly in the form of Treasury bills.
Right.
They're far and away the world's biggest owner of Treasury bills, and that U.S. dollar takedown that we've talked about is killing them. I mean, in terms of their currency, those T-bill holdings are just horrible. They've lost probably $100-200 billion on those T-bill holdings in the last year and a half. It's not pretty.
No.
They bought them for trade reasons, for political reasons, to keep their currency sort of where they want it to be against the U.S. dollar. But still, those have been very expensive holdings for them. And they've said recently, we're not buying any more T-bills. We own all we want. So.
That's right. So
Yeah.
now it's time to buy something else.
Yeah, plus they're the world's biggest gold producer. So for them, it's relatively easy for their central bank to get its hands on the stuff. You basically have to sell it to the central bank there anyway. So they're obviously hanging on to a lot.
Our special guest this week on the Money and Wealth Show is the hard rock analyst, Eric Coffin from Vancouver. And we'll be back with lots more after this.
Always consult your investment professional before making any investment decision.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our special guest this week from HRA Advisories, one of the editors of the Hard Rock Advisor, Eric Coffin. And Eric, in your newsletter, I wrote this down because I love a well-turned phrase, and this one particularly caught my eye. Dollar weakness and inflation are somewhat perversely linked. Explain, please.
Well, normally, in the normal course of events, if you have an economy whose inflation is rising, where you've got this rising price track, normally what would happen is that economy's interest rates would go up. I mean, the real interest rate would stay relatively stable. Inflation would be rising, interest rates would be stepping up right along with it. In the U.S. in particular, you've had this perverse situation where inflation is starting to rise, but interest rates have actually been going down. And that's because you've got a central bank that's stepping on the treasury market. They're basically buying everything they can get their hands on, keeping those rates low. So you're seeing those interest rates drop. The effect that's having is to weaken the currency behind those interest rates, the U.S. dollar. And because of the inverse relationship, you're seeing gold rise in a situation where you'd normally expect the rising interest rates to be backing people off of gold, because gold, of course, doesn't have a coupon. It has no yield. It's not like T-bills. It's a zero interest rate thing. But you're seeing these periods, and we're in one right now, in fact, where because of recent events, the euro is getting hit so hard, you're seeing another one of these perverse flips where the U.S. dollar has been rising quite strongly just in the last few sessions, like since the middle of May, say, and gold's stepping up right along with it. And that's a situation where I think you're seeing people saying, we're a bit scared. So one, we go to the treasury market. The U.S. treasury market is the largest, most liquid market in the world. It does hundreds of billions of dollars a day in trades.
Sure.
So if you're somebody with a really large pool of capital that wants to hide, it's a good place to hide. At the same time, you've got people buying gold, even with a dollar moving higher. I think both of those people are buying for the same reasons. It's probably not the same people, but it's insurance. You can see people are worried again. When you see the dollar and gold moving that way, and the market's red most days, I mean, you got a problem somewhere.
Well, that's rare, isn't it, to see the dollar rather go up and gold go up, because usually it's one or the other.
Yeah, it's gotten a little trickier in the last, in this secular bull market, if you will, especially in the last 3 or 4 years. It's, the correlation, well, it is, the inverse correlation between the dollar and gold prices is quite strong, but it's not 100% anymore, partially because I think there are an increasing number of people treating it as a currency. And the currency, if you think of currency trading, it's always in pairs, right? Mm-hmm. You can't, if you're buying US dollars, you're selling something else, right, and vice versa. I think with the gold, it's the same way. There are people trading it as a currency, but it's not always the dollar on the other side of that trade. It might be the euro, it might be the yuan, might be the yen.
Right.
So the inverse relationship isn't perfect anymore, because someone might be buying gold as a hedge against the euro or against the yen. Or, in other words, if someone's selling the euro, and their hedge might be buying dollars and buying gold, so they move at the same time sometimes. That the inverse relationship is still strong, but it's not perfect anymore, because it's being traded like a currency, so it reacts to a bunch of different currencies, not just the dollar. The dollar is the big one, but it's not the only one.
You talked about the U.S. debt situation, but you've also alluded a couple of times already to European debt.
Yeah.
Which of the two, Eric, is of more concern to you, of greater concern?
I think the European one is, and the reason for that, it's not that it's larger, it's quite a bit smaller, actually.
Right.
But the problem is you have a situation where you're going to have to get a dozen different governments agreeing to the bailout scenario, and frankly, not to put too fine a point on it, agreeing who gets the haircut. I mean, who's going to eat this? Who ends up paying for this? If, be it extending the debt, writing down the debt, however they do it, someone's got to take a haircut for this. And part of the reason why you're seeing so much dissension right now in Europe is, I think a big part of the fight is, who ends up paying for this?
Right.
It's 100%. It's not going to be the Greeks. They should be paying for most of it. But the truth of the matter is, if you've got a debt load that's 150% of your GDP, and your bonds have 16% yields, you're screwed.
And especially when only 20% of your population ever bothers to even pay taxes.
Yeah. I mean, the numbers don't work. The only way that's going to go away is if you either extend those far enough to try to generate something to pay them back, or the banks take a write down, or the ECB takes a write down.
Sure.
Someone takes a write down. I don't think the U.S. at a basic level of being able to generate cash as an economy is in much better shape vis-a-vis its debt than some of those European countries are. So at that level, I'm less worried about it. The big concern in the U.S. is that they've reached their debt ceiling. The Treasury's got things they can do. They've got some open market things they can play around with. It gives them about another month and a half. But the politicians have to agree to raise the debt ceiling in the U.S.
Which they will.
Which presumably they will. But you're going to see a lot of uncertainty until they actually do it.
Right.
I can't imagine either side of the house is crazy enough not to do that, because the repercussions are, you don't even want to go there. So I mean, I'm sure it'll happen, but not before there's 2 months of histrionics and political grandstanding to go through that we all have to listen to. And
that's just beginning. My goodness, the election, isn't it? It's more than a year away.
It never seems to end in that country. It's one big election cycle it just never ends.
As the old saying, it goes, if you think this is grandstanding, brother, you ain't seen nothing yet.
Exactly. No, it's sure to get sillier.
Our special guest this week on the Money and Wealth Show is the hard rock analyst, Eric Coffin. And there's still more ahead. Please stay with us.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com. Or phone me, Larry Ray, at 604-531-9639.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
Welcome back to the Money and Wealth Show. Our special guest this week is the hard rock analyst. One of them, It's a Brother Act, and we've got Eric Coffin with us in studio this week. Eric, your newsletter deals almost exclusively with mining properties at all risk levels.
Yeah.
What is the most popular risk level for your subscribers? Where do the most people go?
I find that most of our subscribers, what they like, by and large, there's lots of different places you can go to get information about the really large producers. So we don't spend a lot of time on those just because we're not going to really add anything that you won't get 100 other places. I find a lot of our subscribers like companies that have apparently made a discovery where Dave and I can look at the projects and say, okay, we can see a target. This thing looks like it has scale. They've got maybe some trenches, maybe a couple of drill holes into it. It's not a slam dunk by any means, but it's also but they have hit what they wanted to hit. Now it's a matter of finding out how big the thing is. That seems to be a level a lot of people are comfortable with. It's not really a swing for the fences. They've already hit something, but there's a lot of room for the company's valuation to grow as the size of the asset grows, as the resource gets bigger. I'd say that's probably the most popular area.
Excuse me, but if you're looking for stocks and you and you don't have all the money in the world, mining stocks are attractive for a lot of reasons, not the least of which, on a per share basis, some of them are really cheap. And if you hit the right one, you're off to the moon. So in terms of risk, I suppose, though, do most people go for the high risk, the low stock, buy a lot of shares of something that may, as you say, may have something because they've done some work? Or do most people prefer to go, well, good that they're starting to do the work, but I'd like to see some more results before I put my money behind them?
I would say most of the people, most of our subscribers, I would say they will have a portion, maybe a half of the funds that are for this sector will be in producers or companies that are near production. Right. And the other half is going to be probably split between these sort of development level, as we call them, ones that obviously have a discovery, but you don't know how big it is yet, and they're working on it, and guys that are speculative. I mean, what we refer to as speculative plays, ones where we've looked at it and they've got, say, a soil anomaly and the right-looking rocks and the right geophysics, and okay, we like the look of this thing. It's a big target. If they hit on the drill holes, it'll go a long way, but it's a spec stock. The drill holes have to hit. The stock will not go up unless they pull a good drill hole.
Sure.
It's a drill spec. That's basically what we call them, and that's what you're playing. I think we have a group of subscribers, especially higher end ones, that like that stuff. But I think most people, I would say that's maybe a quarter or a third of the money they're throwing at this sector. I think you're seeing more people come into the sector for the simple reason that after having gone through 2008, 2009, the end of 2008, commodities are dead, it's all over, it was just a bubble, yada, yada, yada. We were about the only guys saying, look, this is not a bubble, this is a secular bull market. Stick around for a year and you'll see what we mean. Copper went to $1.25. A year later, it was $4.
Sure, yeah.
That doesn't happen in a spec bubble.
That's
if
true.
it had been a spec bubble, that would have been it. The fact it went back up tells you it's something different. It's secular. It's attracting more people simply because these companies are at a production level. A lot of them are making a hell of a lot of money. I mean, they've been very good growth stories in an earnings sense. That's drawn some people in, and a subset of those people, they like playing the exploration, the riskier swing for the fences type.
Sure.
And Dave and I, because we come out of the exploration business, I mean, we admit up front we've got a soft spot for those. But we try to make it clear to readers, like if it's a drill spec, we try to make it plain. This is a drill spec. The drill holes have to work.
And the only way to play that particular game is to be able to just write off whatever you put on the table behind that stock in the first place. You have to be able to just
you have
let
to think
go
that
of
way,
it,
yeah. I mean, we try to find companies that have strong enough management and strong enough balance sheets before that drilling goes on that they're not, the company's not going to fall apart. They'll go looking for another project.
Sure, yeah.
Sometimes they won't even go down that much in price. That's our preference. Our ideal stock, and what we really look for, is ones where the project gets enough attention before the drilling really starts, between the time we talk about it and the drilling really starts. Management has enough strength and has enough credibility that often what you'll get is a nice sort of anticipatory run-up before the drill results start coming in. And if you got it in early, you trade some of your stock out and you bring your average cost down before the drill results even show up.
Right.
That's why right now...
Sort of mitigating the risk. Yeah.
Because things have been sketchy lately, that's part of the reason why we haven't added a lot of those in the last 2 or 3 months, because we like to be doing this in periods where you get anticipatory buying, because that lets you bring your average cost down before the drill results even show up. So if you're not lucky on the drill results, maybe you bought it for 50 cents and you've traded your cost down to 30 before there's even any drill results. So your risk level is really as mitigated as it can be with that kind of stock. I mean, these aren't widow and orphan stocks. Not that there are any anymore, but these ones certainly wouldn't qualify.
Well, it's an interesting sector because there are just so many different possibilities and something for every risk tolerance level, isn't
Oh
there?
yeah, there is, because management has their own risk levels too. So it's a big sector, and there's high risk and low risk and medium risk depending on how far up the food chain you want to go and how spread out you want the company to be. One metal, lots of metals, very large, advanced, just goes with the metal, or a growth story or an exploration story, which is the ultimate growth story. Just depends on what you're comfortable with.
In just a moment, our special guest, Eric Coffin, will have the final word.
The Money and Wealth Show is archived online at talkdigitalnetwork.com.
Looking to advertise to targeted audiences? Online at talkdigitalnetwork.com or howstreet.com. On television, The Money and Wealth Show. And on radio, This Week in Money. To learn more about getting your message in front of our audiences, email us info@howstreet.com or call us 604-699-8600.
You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's your host, Sterling Fox.
And now, with the final word on today's program, here's our special guest, Eric Coffin.
Thanks, Sterling. I mean, one point that we want to touch on, we've touched on it for 10 years now, but we seem to have to keep harping on it. What kind of a cycle is this? Very clearly to us, commodities are in a secular bull market. There's a couple of reasons for that. I won't bore you with all the details, but the important thing to remember is a secular bull market is generally generational. It's not cyclical in the 3 or 4 year sense. They're generally generational. Historically, the average secular commodity bull market was 18 years. We're about 10 years into this one, and I think we've probably got another 10 years to go.
Well, that's welcome news. And it's welcome to see you again. Thanks so much for coming by. It's great to have you on the program. It's been far too long.
Thanks a lot, Sterling.
Our thanks also to Fritz and the gang here at Churchill's at the Holiday Inn in North Vancouver for the superb hospitality. I'm Sterling Fox, and for all of us on the Money and Wealth Show, we'll see you next time.
Thank you.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.